Welcome to Mark Gibson's Human Rights channel. The content to designations CPA, MBA, CMA, ACPA, ASA, Australia. Enjoy learning!
So today we'll discuss about short-term financing management. Okay, so this will be the last part of the working capital management. We have discussed cash management, receivable management, and inventory management, and those form part of your current asset. And now we'll go to the next part of your working capital, which is your current liabilities. So in short-term financing, we'll be dealing with three groups. This will be the focus of our discussion on short-term financing, namely spontaneous sources, unsecured short-term credit, and short-term and secured short-term credit. So in current liabilities, we're going to dealing with the managing and cost of sales short-term financing. So let's now go to the first group, which is your spontaneous sources. So spontaneous sources, basically these are your short-term financing, which are directly related to sales or directly related to your operating cycles. No? So there are three examples of spontaneous sources of short-term financing. Number one, accruals. These are your accrued expenses. So it forms part of your spontaneous financing, which represent liabilities for services that have been provided to the company but have not yet been paid for. So expenses already incurred but not yet paid. Next, deferred income. Deferred income, these are customers' advance payments or deposits for goods or services that will be delivered at some future date. So your deferred income or your unearned income, these are income already received but not yet earned. So the first two sources of spontaneous liability, these two generally do not have cost. No, so it's non-interest bearing. So that's why we don't compute for cost of short-term financing in these two. No, but for the third one, trade credit, these are considered as a spontaneous financing because it is automatically obtained when a firm purchases goods or services on credit from a supplier. This one, Plaza, take note. If a supplier allows a trade discount for prompt payment, an implicit cost is incurred if the discount is not availed of. So, ulitin natin yung discussion. No? So, basically in spontaneous sources, these are non-interest bearing. We do not compute for cost of short-term financing because like I said, it's not non-interest bearing. But for number three, for trade credit, we compute for cost of trade credit only when there is a trade discount and if we do not avail of this trade discount. So for example, our credit terms would be uh, 2/10 n/30. So meaning if you pay within 10 days, you'll get 2% discount. If we do not pay within 10 days and we forgo the 2% discount, then that's the time we need to compute for the cost of trade credits because here we're talking of the opportunity cost, no? Okay. So let's discuss now the general formula to compute for the cost of short-term financing. Remember class, in spontaneous sources 1 and 2, we do not compute for cost of short-term financing. But in number 3, we only compute for cost of trade credit if we do not avail of the trade discount. No? So take note of that. Now let's discuss the general formula. Okay, chinek ko lang kung baka nakamute ako, sayang naman. Okay. Okay, so the annual cost rate is computed by dividing interest cost per period over usable loan proceed or usable loan amount, or simply your loan proceeds, no? Multiply by the number of days in a year over the number of days funds are used. Or simply, ito yung modified formula, it's the same, no? So your discount percentage over 100 minus the discount percentage multiplied by the number of days in a year, net period less discount period, no? So either of this formula will give you the same result, no? So that's how to compute for your cost of short-term financing. Now let's apply this formula to our exercise number 1 on trade credit. So we have 3 suppliers, A, B, and C. Actually, the requirement is to compute for letter A, what is the nominal cost and effective cost of giving up the cash discount from each supplier, and letter B, assuming that the firm needs short-term financing, recommend whether it would be better to give up the cash discount or take the discount and borrow from a bank at 20% annual interest. No? So basically in letter B, we're just going to recommend whether to avail the cash discount or not, no? Or simply borrow from a bank at 20% annual interest. So there will be 3 suppliers. There's the credit terms and the date of payment. Let's apply this. Let's apply the formula to calculate for your cost of short-term financing, or basically your or your trade credit, cost of your trade credit. No, so we have nominal cost and effective cost. Probably let's discuss first what's the difference between nominal cost and effective cost. No, so when we say nominal cost, this doesn't include the compounding. So meaning it happens one time lang. And when we speak of effective cost, this already includes compounding, meaning these events happened a number of times in a year. No, so in nominal cost, this could happen only once. No? Okay. So let's do exercise 1. I hope you can see my Excel file. And here's the calculation. Okay ko lang to. Okay. So dito muna tayo kay supplier A. Focus on supplier A, ha? So remember, the formula is discount percentage over 100% minus the discount rate multiplied by the number of days in a year, and then the net period minus the discount period. So class, if the problem is silent, let's use 360 days. Okay? Okay. Sige. So, the discount percentage in number 1 is of course 3. Kasi ito yung credit terms natin, di ba? 3 over 15, net 40. So, meaning, if we pay within 15 days, we'll get 3% discount. So, 2 over 10, so 2%, and 1 over 5, so that's 1%. So, okay na tayo kung paano nakuha yung 3%. So, that's 3 over 15. So, 3 represents the discount percentage, no? And yung 97% ay yung formula, 100% minus the discount percentage. So that's 100 less what? 3%. So that's 97%. Okay pa tayo dyan? punta natin yung next part ng formula. So number of days in a year, like you said, if the problem is silent, let's use 360. So that's 360 days. Pag-usapan natin tong net period minus the discount period. Okay, so sabi, net period minus the discount period. So you have your 30 days. 30 days represents the date when the payment was made, no? So 30th day. So we paid the loan on the 30th day. So that's 30 less what? The discount period. Discount period is 15. So 3 over 15. So 3% when you pay within 15 days. So that's 15, 30 minus 15. Okay? So kunin lang natin yung calculation. So 3 over 97%. So that's 3%. 360 over 15. That's 24. Multiply the 2. Ayun yung formula, no? So that's 74.23%. Okay? Puntahan natin tong supplier B. Okay. Si supplier B, the credit term is 2 over 10 net 30. Okay, so your discount again, discount is 2%, 100 minus 2, so that's 98%. Again, if the problem side, let's use 360, so that's 360 days, number of days in a year, and the net period, so that's 35. 35 minus 10. No? So that's the discount period. So of 25. So let's calculate. So that's 2% over 98%. So that's 2%. 360 over 25. That's 14.4. Multiply the 2. So you'll get 29.39%. Okay. Okay, so let's go to supplier C. Okay. For supplier C, lagyan ko nga ito ng parang hindi nakakalito. Okay. So for supplier C, sabi natin the term is 1 over 5 net 20. So if we pay within 5 days, we get 1% discount. So let's again derive the formula. So discount percentage is 1%. Okay. 100 minus 1%, so that's 99%. 360 days. Net period is 30 less 5, so that's 25 days. So let's calculate. So that's 1% over 99%, so that's 1%. Next is 360 over 25, so that's 14.4. So then we get, multiply the two, 1% multiplied by 14.4, so that's 14.55%. Okay, that's how we compute for our nominal cost, or this is the cost of trade credit. Now, the next requirement is to compute for the effective cost. Again, class, for effective cost, we have to include compounding. No? So again, like I said with you in our previous sessions, learn to compute for the compound interest rate using your calculator. No? So kasi in scientific calculator, you can simply just include that part. So it's easy using your scientific calculator. But if you're using a basic calculator, so I've taught you about how to calculate this during our discussion of capital budgeting. So all you have to do is familiarize yourself how to calculate for your interest rate with compounding using your manual calculator. No? Okay. So ito, gagamitin natin yung scientific calculator. No? It's easier to use that. Okay. So how to calculate for your effective cost of trade credit. So again, here's the formula. Na-calculate naman na natin yung 97, 98, and 99. Etong yung factor na to, same pa rin. Yun pa rin yung gagamitin natin. But instead, kung napapansin mo, yung nakuha natin sa second portion, yung number of days in a year, instead of just multiplying it, nire-raise natin, no? Raise to the 24th power. Okay? So that's 1 plus, yun nga, yung first portion of our formula, 3% over 97% raised to the 24th power minus 1. Okay? So that's 107.72%. Supplier B, so 1 plus 2, same pa rin naman, 2 over 98% raised to the power of 14.4 minus 1, so that's 33.77%. And finally, for supplier C, so that's 1 plus 1% over 99%, same pa rin. We're still following the modified formula, but in this case, instead of just multiplying it, we raise it to the power of 14.4, no? And ayun, minus 1, so that's 15.57%. Again, this is how we calculate for the compounded or the effective cost of trade credit. No? And in letter B, assuming that the firm needs short-term financing, recommend whether it would be better to give up the cash discount and borrow from a bank at 20% annual. No? So in supplier A and B, our answer is no. And then for supplier C, yes. No, it's better to give up the discount and borrow from a bank at 20% annual interest, for the reason that we calculated it at just 15.57%. Okay, so that's how we calculate for our cost of trade credit. Again, class, we only calculate for cost of trade credit if we forego the trade discount. No, if not, we don't have to calculate for the cost of trade credit. Okay, so I hope that that's clear enough. Actually, the calculation is also provided in my PowerPoint presentation. So just provided you also the calculation in Excel file, at least for you to see how the calculation goes. No? Okay, so we go now to our next set or next group in short-term financing. So this is the unsecured short-term credit. So for what's this unsecured short-term credit? No, so basically still a short-term financing, still but unsecured. No, so we have 4 groups. No, so number 1, we have commercial bank loans. So these are short-term business credit provided by commercial banks, requiring the borrower to sign a promissory note to acknowledge to acknowledge the amount of debt, maturity, and interest. Simply, these are your bank loans. Number 2, line of credit. The bank agrees to lend up to a maximum amount of credit to a firm. This is applicable to firms that need frequent funding in varying amounts. So basically, class, line of credit and commercial bank loans, they are the same. But in line of credit, instead of in bank loan kasi, you have to present documentations to the bank and they approve it every now and then. No? In line of credit, this is there's a cap, say 1 million. So up to 1 million, it's approved. You can simply just present it to the bank, and the bank will give you the loan. So that's the only difference between the two. Number 3, revolving credit agreement. The bank makes a formal contractual commitment to provide the maximum amount to the firm. The firm pays minimal commitment fee per year on average unused portion of the commitment. So basically, a revolving credit agreement, this is kind of the same with line of credit. The only difference is that in revolving credit agreement, there is a contractual commitment, no, meaning you have to use the whole amount as agreed within a given period. Otherwise, you'll have to pay for a minimal commitment fee. Okay. And finally, transaction loan, a single payment loan or short-term credit for a specific purpose. Okay. So in an unsecured short-term credit, we'll be dealing with the cost of bank loans. No? So that's number 1. Okay. So to calculate for cost of short-term bank loan, the modified formula is so annual cost of short-term loan. So that's net interest over the usable proceeds multiplied by the number of months in a year over the term. Okay, so this is the modified formula. But how are we going to calculate for the net interest? Ito rin, class. So net interest is computed as interest expense paid, transaction costs, or ito yung mga say issuance costs or flotation costs, no? So that's your transaction costs. I-add mo pa rin. Interest income on incremental compensating balance. So i-deduct natin yan. Again, pag-usapan natin tong incremental compensating balance. So for example, the company agrees to approve your bank loan, no? Provided that you have to maintain a certain balance in your bank account. So sabi natin na sige, ako si bank, no? So Mark Bank will agree to issue a loan to BSA Corporation, provided the BSA Corporation make sure that it has 50,000 balance in the bank. So yun. And pag sinabi rin na nag-i-interest, definitely nag-i-interest kasi yung compensating balance natin. So therefore, the amount that we recognize at interest income for that compensating balance must be deducted to get your net interest, no? Pero class, pansinin, meron dito incremental. Ano ba ibig sabihin ng incremental? Meaning this is just the difference. So, paano yun? Considering do sa example natin kanina, no? Sa BSA Corporation, is it being required by Mark Bank to have a balance in its account of 50,000, no? And what if at the beginning meron ka na doon 30,000? So the incremental is only 20,000, meaning you only need to compute for the interest income of that 20,000 you have added to complete the 50,000 compensating balance required. Okay? Sige. So medyo nakakalito pa, pero later on pag nilagay natin sa problem, in-apply natin sa problem, mas maiintindihan pa ba't ganun yung ginagawa, no? Okay, so pag-usapan natin how to compute your usable proceeds. Kasi paano ba pag sinabing usable? Meaning, kasi pag sinabing proceeds, ito yung na-receive mo. Pero hindi naman lahat ng nare-receive mo, nagagamit mo talaga. Paano? Pag-usapan natin. So definitely, the initial item that we have to compute for your usable proceeds will be your principal amount. So kanina nagpautang si Mark, di ba? How much? 1 million. So that's your principal amount. Discount or your advance interest paid kasi usually the bank also provides for, also deducts advance interest, no? So with that, we have to deduct it from the principal amount, no, to calculate for your proceeds. Siyempre, inaalis din yung transaction cost. Okay na yan, wala tayong problema dyan. Kasi binabawas na yan dun sa amount of money na talagang binibigay sa ng bangko, no? Pag-usapan natin ngayon ditong incremental compensating balance. So what if BSA Corporation initially doesn't have account with Mark Bank? So therefore, iba na bawas na ni bangko yung incremental compensating balance. So in our example, the compensating balance required is 50,000. So therefore, binabawas na ni bangko. Binabawas na natin yun dun sa proceeds na nare-receive natin. No? So to calculate our usable proceeds, instead, we deduct the incremental compensating balance from the principal amount. Okay? Sige, pag-usapan natin yan more. Ito, we have 1, 2, 3, 4, 5, 6 examples, no, to calculate for your cost of short-term bank loan. Sige, pag-usapan natin isa-isa. The requirement is brand companies negotiating with Brom City Bank for a 1 million one-year loan. Brom City Bank has offered brand company the following alternatives. So we have to calculate the effective annual interest rate for each alternative. So that's one. Number two requirement is we have to redo all of this proposal now using 4 months, no, as term. So una is 1 year. The second one is for 4 months only. Okay. So let's do that now. Sige. Sige. Pag-usapan natin yung requirement A. Sabi, a 12.5% annual rate on a simple interest loan with no compensating balance required and interest due at the end of the year. So, remember, ang loan na pinag-uusapan natin is 1 million. Magkano daw yung interest? So, 12.5. Compute natin ngayon isa-isa. Net interest. So the net interest is simply your 1 million multiplied by 12.5%. Okay tayo dyan. Parang sakit ng red. Huwag tayong red. Gawin kong blue. Usable proceeds. Yan yung pag-usapan natin. So in this case, sabi, no compensating balance and interest due at the end of the year. So walang ibang factors, walang advance interest payment, walang incremental compensating balance, wala rin transaction cost. So therefore, your usable proceeds is 1 million. So the answer for letter A is 12.5%. So that's 125,000 divided by 1 million. So 125,000, this is your net interest divided by usable proceeds of 1 million. So that's 12.5%. Let's go to proposal letter B. So again, the loan is 1 million pesos. Here, letter B, a 9.25% annual rate on a simple interest loan with a 20% compensating balance required and interest again due at the end of the year. Ayan na. Meron na tayong pinag-uusapang compensating balance. Okay. So sa letter B, how much is your net interest? So again, 1 million multiplied by 9.25%. So that's 92,500. Usable proceeds, so meron ka 1 million. Yan yung principal amount natin. And then the compensating balance. Sabi, there's a required 20% compensating balance. So that's 1 million multiply by 20, so that's 200,000. So we get the total of the two, so that's 800,000. Okay, so the answer for letter B is 11.56%. So that's 92,500, your net interest, divided by 800,000 usable proceeds. So that's 11.56%. Okay? Sige, pag-usapan natin yung proposal C. Sabi dito, 8.75% annual rate on a discount loan with a 20% compensating balance. So again, pag sinabi nating loan discounting, meaning the interest is already paid in advance. Okay, so let's compute for our net interest. So net interest, that's 1 million multiplied by 8.75%. So that's 87,500. Let's now calculate for our usable proceeds. No? So for our usable proceeds, we have principal of 1 million. Compensating balance, paano nga ulit yun? 20% of 1 million, so that's 200,000. And the interest, sabi, paid in advance, so that's 87,500. Let's get the sum, so that's 712,500. So the answer for proposal C is 12.28%. So that's 87,500 net interest divided by 712,500 your usable proceeds. So that's 12.28%. Okay? Ito different yung actually proposals A to F. These are different scenario to show to you how to calculate for your cost of short-term bank loan. Kung napapansin nyo, ang nagbabago lang naman talaga is yung component ng usable proceeds and as well as components of your net interest. This net interest, okay? So let's go to letter C. Letter D, proposal D. In proposal D, sabi 8.75%, okay, discount loan pa rin, with 20% compensating balance and an existing cash balance of 150,000. Ito class, no? Ito na yung example natin kanina na meron na tayo ditong existing cash of 150,000 and i-require ka to have 20% compensating balance. So therefore, your incremental compensating balance, yun lang yung kailangan nating component to calculate your usable proceeds. Okay? So isa-isa natin. Again, the loan is 1 million. Let's calculate for your net interest. Simply 1 million multiplied by 8.75%. So that's 87,500. Dito nagkaroon ng kakaiba sa pag-compute ng usable proceeds. So meron kang principal of 1 million. Okay, yan. Wala tayong pag-uusapan. Interest, wala rin tayong pag-uusapan kasi napag-usapan natin yung kanina. No? Simply 1 million multiplied by 8.75%. Dito sa compensating balance, instead of simply multiplying 100,000 by 20%, so that's 200,000, no? Pero meron ka na daw kasing balance sa bank na 150. So therefore, magkano lang yung dinedagdag mo? Yun yung incremental. So that's 50,000. Basically, 200,000 the required. At since meron ka ng 150,000 na meron ka ng 150,000 na balance sa bank, so kunin lang natin yung 50,000. Okay? So let's get the sum. So that's 862,500. The answer to letter D is 10.14%. Okay? So that's 87,500 divided by 862,500. Okay? Pag-usapan natin si letter E. Si letter E, 8.75% annual rate on discount loan with a 20% compensating balance. Ito na, which earns 5% interest income. Okay. So, pag-usapan natin yung net interest. Again, net interest. So, compute natin yung interest expense. So, that's 87,500. 1 million multiplied by 8.75%. Then, sabi dito, interest income on incremental compensating balance. So, compute natin yung interest on compensating balance. Magkano nga yung compensating balance na nire-require? Sa letter E, it's 20%. So, 20% of 1 million, so that's 200,000 multiplied by 5, so that's 10,000 pesos. So, sabi natin, to compute for your net interest, we have to deduct that. No? So, yung interest on CB. Lagay ko na dito, compensating balance. Okay? So, that's 10,000. Paano ulit na-compute yung 10,000? 200,000 compensating balance multiplied by 5%. So, that's 10,000. Let's get the sum. So, that's 77,500. Okay? Next, on the usable proceeds, meron tayong 1 million principal compensating balance. Sabi 20% required. So that's the compensating balance. I-deduct din natin yung interest of 87,500. Let's get the sum. So that's 712,500. So divided to 77,500 divided by 712,500. So that's 10.88%. So that's our answer to letter E. Okay. Ngayon, pag-usapan natin yung letter F. But this time, 8.75% annual rate on a discount loan with a 20% compensating balance and an existing cash balance of 150,000. The bank balance earns 5% interest income. Same naman to sa letter E. The only difference is that we already have 150,000 pesos cash balance. No? So therefore, ang kailangan lang natin i-calculate ng interest, income, and at the same time compensating balance will be the 50,000 pesos. No? Yun lang difference. Incremental compensating balance. So that's 50,000. So therefore, instead of using 200,000, kunin lang natin is 50,000. So 50,000 multiplied by 5%, so that's 2,500. Okay, so let's get the sum. So that's 85,000 for your net interest, and then for your usable proceeds, that's 862,500. So that total is let's divide the two. 85,000 divided by 862,500. So that's 9.86%. Okay. So this is how we calculate for your cost of short-term bank loan. Ito, yung calculation natin, if it's for 12 months, no? For 1 year. No? What if 4 months lang yung nire-require sa atin? What if hindi for full year? Okay, so pag-usapan natin yan dito. Lagay ko lang to dito para masundan pa rin. Dito na tayo sa requirement B. Redo requirement A to F. Assuming the loan is 4 months. So, kanina kasi is for 1 year. Okay? So, paano naman kung for 4 months lang? Okay? O, dito na tayo. So, ang kailangan lang natin, kasi ang pinapakompute pa rin sa atin is yung cost of short-term. Cost of short-term loan, no? But right now, the terms is for only 4 months. No? Kailangan lang natin kunin yung pinaka-annualization factor. Tandaan, kailangan natin kunin yung annualization factor of 4/12, 4 months, no? Over 12 months for all interest, expense, and interest income only. So yung 4/12 na factor natin, this is only applicable to interest, expense, and interest income. Okay? And then later on, pag nakuha na natin yung net interest and usable proceeds at na-divide na natin yun, kailangan natin factor in naman yung annualization factor. Okay? Sige, pag-usapan natin isa-isa. Okay. Dito muna tayo kay proposal A. Okay? Sige. Okay, proposal A, same, no? So 1 million over 1 million for 12.5% annual rate, no? Annual rate kasi ito, no? So kailangan ang pinag-uusapan lang natin is 4 months. So kailangan natin kunin yung 4 months lang. Okay? So net interest 125,000. Again, this is applicable for 1 year. So kunin natin ano ba yung applicable for 4 months lang. Kaya nilalagyan mo ng 4 over 12. No? So that's 41,667. Usable proceeds of 1 million. Oh, so wala naman tayong pag-usapan dyan kasi nga yung 4 over 12 na term is only applicable for interest expense and interest income. So that's 1 million. So let's divide the two. 41,667 divided by 1 million. So that's 44.17%. Kunin natin ngayon yung annualization factor na 12 over 4. 12 months over 4 months. Kunin lang natin, kailangan kasi natin ma-calculate yung annual effective, I mean annual cost of trade credit or annual cost of short-term loan. So 4.17 multiplied by 12 over 4, 12.4. So that's 12.5%. Ito naging 3 kasi 12 over 4. No? 12 divided by 4, kaya 3. Okay? So kung napansin mo, nagkataon lang na same yung sagot natin sa requirement B. Ngayon pa rin, 11.56, 12.20, A and B, no? Pero pagdating dito sa letter C, na iba na. Pag-usapan natin tong letter C. So sa letter C, baba ko to ha. Para masundan natin yung... Okay, dito tayo kay letter C. Again, meron tayong net interest. So 4 over 12, that's 29,167. Pagdating dito sa usable proceeds, meron tayong principal, compensating balance, okay, of 200. Same pa rin naman yan. Now, meron tayong interest. Sa letter B, sabi, interest, letter C pala, discount on loan. So meaning, we're paying the interest in advance. But here, we have to calculate for 4 over 12. No? So that's 29,167. So get the sum. So that's 778,833. And then divide the 2. So 29,167 divided by 770,833. That's 3.78%. Kunin natin yung annualized factor of 12 over 4. So that's 11.35%. Actually, class, parehas lang naman yung ginawa natin to compute for the net interest and usable proceeds. No? Same yan. Ang naiba lang, nilagyan natin ng factor na 4 over 12, yung net interest at saka yung interest income. So, yan. No? Diyan lang na iba. Yan. And then, after calculating that, sige, pag-usapan natin tong letter D. Okay, letter D, baba ko to para hindi nalilito sa formula. Okay, letter D, meron ka pa rin interest. Factor in natin yung 4 over 12, 4 months over 12 months. Kasi nga, ang requirement natin is assuming the loan is for 4 months lang. Baka naman, ngayon pa rin, nalilito pa rin dyan. Okay? So that's 29,167. Usable proceeds, ganun pa rin. Meron ka 1 million na principal. Compensating balance kasi sa letter D, meron ka ng existing na 150. Magkano lang idadagdag mo to complete the 20% compensating balance? 20% is 200,000. So meron kang existing na 150,000. So therefore 50,000 lang yung kailangan mong i-add. The advanced interest, so compute lang natin 4 over 12, so that's 29,167. Get the sum, so that's 920,833. Divide the two, so 29,167 divided by 920,833. So that's 3.17%. And then multiply by the annualized factor of 12 over 4, so we'll get 9.50%. So that's requirement D. Okay? Pag-usapan natin yung requirement E. So again, net interest and then interest on compensating balance of 10,000. Factor in 4 over 12 para makuha natin yung interest for 4 months and interest income in this case of 4 over 12. So net amount, net interest is 25,833. Usable proceeds, meron kang 1 million na principal, compensating balance of 200,000, and then yung interest, advance interest payment of 87,500 will get the factor, yung magkano lang nabayaran natin for 4 months, so that's 29,167. So get the sum, so that's 770,833. Let's divide it. So 25,833 divided by 770,833. So that's 3.35%. Multiply by the annual factor of 12 over 4. So that's 10.05. That's our answer to letter E. Finally, on letter F, net interest, ganun pa rin. Pero factor in 4 over 12, so that's 29,167. Interest on bank loan, interest income on bank balance, no? So that's 2,500 multiplied by 4 over 12, so that's 833. Let's get the sum. So 2833, that's 28,333. Usable proceeds, meron ka 1 million na principal. Compensating balance of 50,000. Interest, ganun pa rin, i-multiply mo lang by 4 over 12. So the sum is 920,833. 28,333 divided by 920,833. So that's 3.08%. Multiply by the annual factor of 12 over 4. So we'll get 9.23%. So that's our answer to letter F. Okay, so that's 6 examples, no? Actually, 12 examples to discuss or to illustrate cost of short-term bank loan. Okay? So I hope that's clear enough. We go now to the third portion of short-term financing. And actually, let's do another example. An unsecured short-term credit naman. So commercial paper, short-term unsecured promissory notes, yung mga IOUs natin, issued by large firms with great financial strength and high credit rating to other companies and institutional investors such as trust funds, banks, and insurance companies. Commercial papers entail lower cost than bank financing. Ayun, yun pala yung difference doon. No? For cost of commercial paper, the modified formula is, ito na, interest plus issue cost over face value minus interest minus the issuance cost multiply by 360 days. Again, if the problem is silent, let's use 360 days. Pag hindi naman at sinabi na 365, then 365 over the term. Okay? Sige. Let's discuss exercise number 3 to illustrate cost of commercial paper. Okay. So here, meron tayong, same pa rin naman eh. Kung napansin mo, yan pa rin yung formula natin dito. Ang naiba lang, in commercial paper, meron tayong issuance cost. Yun lang ang naiba. Pwede rin natin tawagin itong issuance cost na transaction cost or flotation cost. No? So let's compute for our net interest. So meron kang 1 million. Ang proceeds mo is 985. So therefore, meron kang interest of 15,000. Issuance cost given, so that's 2,400. So our net interest is 17,400. Okay. Meron ka principal of 1 million, interest of 15,000 na pag-usapan natin yan, and then less the issuance cost of 2,400. So your usable proceeds is 982,000. Okay? So that's 17,400 divided by 982,600. So that's 1.77%. Yung annual factor natin of 12/4 kasi nagkataon na 4-month commercial paper to, 12/4. So that's 5.31%. Okay? Meron ako ditong note. The assumption here, that this 15,000 is already multiplied by 4/12. Why? Kasi nga naman, dineduct niya na doon sa 985,000. So meaning, ito na talaga yung expense. This is already your interest expense representing 4 months. No? So we don't need to compute. We don't have to compute for the factor of 4/12, no? Because it's already representing 4 months. Actually, mali yung sabihin na assumption. No? It is already multiplied. No? Okay. So this is how to calculate for the cost or the annual cost of commercial paper. Okay. So like I said, nandiyan rin naman sa PowerPoint natin yan. Okay. So let's now go to the last part of short-term financing. This is secured short-term credit. Number 1, pledging receivables. A certain peso amount of receivable is provided by the borrowers as collateral for a short-term loan. So basically, secured short-term credit. Kaya nga secured, meron kang collateral. So in pledging receivables, your collateral is the receivable. Pledging inventories, part or all of the borrower's inventories are provided by the borrowers as collateral for a short-term loan. So in this case, yung inventory, yun yung pinaka-collateral natin for the loan. Factoring of accounts receivable. A factor buys the accounts receivable of a firm and assumes the risk of collection. So class, factoring is simply sale of accounts receivable. Yun lang yun, no? So binibenta natin yung accounts receivable to firm. Yung binibenta natin yung accounts receivable natin to a firm, and the firm now assumes the risk of collection. Number 4, bankers acceptance. So often used by importers and exporters. These are drafts drawn by non-financial firm on deposits at the bank. The bank's acceptance is a guarantee of payment at maturity. So basically, the collateral here is yung pag-accept mismo ng bangko. Okay? Sige, pag-usapan natin to, no? Factoring of receivables. So that's exercise number 4. So exercise number 4, what are the requirements? Letter A, how much is the monthly net proceeds from factoring the receivables? Meaning, magkano yung na-receive natin from sale of receivable. Number 2, what is the annual net cost of factoring? Letter C, what is the effective annual cost rate of financing? And finally, letter D, if the interest charge and factor's fee is not deducted in advance, the effective annual cost rate is, okay. Sige, pag-usapan natin yung isa-isa, punta muna natin yung data. Camille Corporation enters into an agreement with the firm that will buy Camille's accounts receivable and assume the risk of collection. So details are as follows. We have average amount of receivable to be factored each month. 300,000. Average collection period is 30 days. Amount to be advanced by the factor. So 75% of the face amount of the receivable. So 75% of 300,000. No? Interest rate, deductible in advance. O yan na, sinabi na deductible in advance. Factor's fee, deductible in advance, 3%. Annual savings of Camille Corporation in collection expenses. So meaning, Magkano daw yung na-save ni Camille for selling in selling its receivable, no? Kasi nga binenta ni Camille yung receivable niya, nabawasan yung collection expenses niya. So therefore, ito daw 40,000 yan yung savings ni Camille. Okay? Sige, pag-usapan natin yan isa-isa. Letter A, compute for the monthly net proceeds. Tandaan na, itong 300,000, this represents 1 month lang, no? Average amount of receivable to be factored each month. Okay? So how much is your face value? So that's 300,000 given. How much is the factors holdback? Ayun, 75% of the face amount of the receivable. So meaning, ibibigay din naman 'yan. Parang ito yung compensating balance natin, no? So that's 75,000. So 300,000 multiplied by 25% o yung factors holdback. Kasi nga, yung 75%, yan yung ibinayad na agad. Okay? Ulitin natin para hindi nakakalito. Meron kang 300,000 na receivable. Binibenta mo yan kay, meron ba sinabi pangalan? Binibenta yun doon sa isang firm. Ngayon, ina-advance na daw ni factor o yung bumili, yung 75%. So yung 25%, yun yung hino-hold niya muna. Hino-hold muna nung company. So ito yung pinaka-compensating balance. No? Okay. So factors fee, so that's 9,000. Paano kinompute? So 300,000 multiplied by 3%. Ito yung binabayad natin dun sa firm na bumili ng accounts receivable natin. Interest. Ito, paano yan? So that's 300,000 less 75,000. Siyempre, ako computan lang natin yung ng interest ay yung proceeds natin, no? Multiply by 12% kasi ayan, interest is 12%. Pero tandaan, this is per annum. So kukunin natin yung for 1 month lang. So that's 30 over 360. Ito, simple lang naman ang pag-compute ng interest rate. Interest. Ito no? Di ba, you have your PRT, principal, multiply by the rate, multiply by the terms. No? In this case, given yung rate but in for 1 year. So kunin mo lang yung 1 month. So that's 30 over 360. Okay. So your net proceeds is therefore 213,750. Get the sum lang. Okay. So that's answer to letter A. So letter B, what is the annual net cost of factoring? Magkano ba yung annual net cost? Excuse me. Pansinin. Ang pinapakompute dito is your annual net cost. Annual net cost. Ha? So remember, meron ka kanina factors fee na 9,000. Paano nga na-compute yung 9,000? 300,000 multiplied by 3%. So that's 9,000. Pero kailangan mo ngayon is annual. So multiply by 12. So 9,000 multiplied by 12. So that's 108,000 pesos. Interest, again, kanina na-compute natin 2,250 but that's equivalent to 1 month lang. So, compute natin yung for 1 year. 300,000 minus the factors holdback of 75,000 multiplied by 12%. So, that's 27,000 pesos. And finally, your annual net savings of 40,000. So, your annual net cost of the annual net cost is 95,000. Okay? Pag-usapan natin yung letter C. What is the effective annual cost rate of financing? Your formula is your annual net cost over the net proceeds. So basically, letter C, pinag-ready ka na ng letter A and B. No? So how much is your annual net cost? Ayun, 95,000. How much is your net proceeds? Ayun, 213,750. Therefore, answer to letter C is 44.44%. So that's your effective annual cost rate of factoring your receivable. Okay? Letter D, ito, same naman, pero sabi lang, what if the interest charge daw and factor's fee is not deducted in advance. Okay, so let's compute for our net cost. No? So same, meron kang annual factor's fee of 108,000, interest of 27,000, and then annual net savings of 95,000. Okay, so same naman yung annual net cost mo. Ang nabago lang is yung proceeds kasi nga hindi na dinededuct in advance yung interest and factors fee. So therefore, your net proceeds is 225,000. So that's 95,000 divided by 225,000. So your effective annual cost rate is 42.22%. Okay. So yeah, that's also the calculation. No? So okay, that ends our discussion on short-term financing management.
This has been your instructor, Mark Gibson. Thank you for learning with us. See you in our next discussion. Don't forget to like and subscribe. See ya!